Hi, everyone. How are you? Thank you so much for coming this evening. I'm thrilled to welcome you to the Stash webinar, Get Schooled with Stash. We're going to start in just a minute, letting everybody join and get settled. Pull up a drink, a glass of water, something. We have a really great lineup scheduled for you this evening. So welcome, welcome. So happy that you're here. I'm Sarah from Stash. It's great to have you all. So many people already here. Excited to learn with us. Investing 101. It's part of a two-part series. The next one is next Tuesday. So we'll see you tonight. We'll see you next week. Thrilled to have you here. Doug, you ready to go? Ready to go. All right, so many of you here. Again, welcome. We're going to get started. Thank you for coming to our webinar today, everyone. It's part of our Get Schooled with Stash program, a month of education and guidance just for you. Here at Stash, we believe that lessons on money belong in the classroom, and it's a shame that they're often not. So we're here to fix that right now with a webinar tonight, and as I mentioned, next Tuesday too, covering investing basics tonight and some advanced topics next week. Lots of great content. So as I mentioned, next slide, this webinar is part of our Get Schooled in Stash program, which also has a sweepstakes component. Register for these two webinars and switch your subscription to an annual subscription at a discount, and you'll be entered to win an entire year of Stash on Us, one whole year of Stash on Us, 10 lucky winners. Also, if you're investing over the course of a whole year and you turn on auto invest, most people set aside about $1,000 in 1 year. So a full year is a great amount of time to be investing with us. We have a great lineup for you tonight, so much to cover. I've invited Doug Feldman, Stash's Chief Investment Officer, to join us today. Hi, Doug.
Hi, Sarah. Hi, everyone.
He oversees our investment strategy and recommendations and leads the team that provides key market commentary, education, and financial advice. He's going to start with a quick news brief because we've had a lot of news in the last 24 hours on the markets. He's going to talk about interest rate cuts and what that means for our investing and our wallets. And then we'll go into our curriculum for Investing 101. So I think we'll just take these slides down for just a minute. And Doug, maybe I could just ask you a couple questions on the news. We'll just stop sharing the slides for a second. Yeah, great. All right, Doug. Okay, so the Fed announced interest rate cuts yesterday for the first time in 4 years since 2020. Federal Reserve Chair Jerome Powell called it a recalibration. So can you tell us what that means, what we should know about this, and what we should take away one day later?
Absolutely. Well, first off, welcome everyone. Hi, Sarah. It's always good to join you on these, and welcome everyone that's attending. We have just looking at the numbers, a very large crowd here today. So I'm glad to see you all, although I can't see all of your faces. I'm glad you're all joining us today. So in terms of the Fed, let me just take one major step back and just describe the Fed. The Federal Reserve is a government entity that sets interest rates, and they set interest rates and they use interest rates to either speed up or slow down the economy. So if the economy is not growing so fast or we're having issues, maybe they cut rates. If the economy is growing too fast or inflation is high, they raise rates. And so if we take a step back, prior to COVID, interest rates were around the federal Fed funds rate, which is the rate they set, was just over 2%. COVID broke out. The world was in a very troublesome state, and they cut rates down to basically zero. Their target rate was 0 to 0.25. And then, as everyone can remember, and people remember in their pocketbooks and wallets, that prices started going up in 2021, 2022 as a result of all of that. And so the Fed started taking some drastic measures to slow down that inflation and to slow down the overheated economy. And through 11 raises between early 2022 and mid 2023, they raised rates about 5.25%. And rates have been there for the last year or so. And yesterday, it was yesterday, they came out and they made an announcement to cut rates for the first time by 50 basis points, or by 0.5%. Now, What does that mean? They're coming out, the Fed came out and they talked about this recalibration. And they had two mandates. One was to make sure that the economy is growing, and two is to make sure that inflation is not too high. They believe, or the Fed has announced yesterday, that maybe the inflation is curtailed right now. The increase in prices is going to be curtailed. And what they want to do is they want to make sure that the economy stays strong and robust going forward. So they announced this cut. People were expecting either 25 basis points or 50 basis points. They went to 50, which was slightly bigger than maybe consensus was somewhere in between there. And at the same time, they really talked about really managing and recalibrating and managing the economic growth, which was viewed positively today.
Well, but tell us what happened today in the market.
Oh, that's a great thing. So today, the U.S. markets hit an all-time high once again. The S&P 500, which is the index of the 500 largest public companies in the U.S., which is when people say, how did the market do? They generally are talking about the S&P 500. That closed at an all-time high, just over 5,700. And I was looking at the stats, unbelievable. We've had 39 record closes so far in 2024. And despite us only being halfway through September, the market is up basically 20% so far this year, which is a pretty strong year. Not something I would not, going forward, not count at 20% per year, but it's a pretty big growth in 9 months.
And I think what we talked about yesterday, a little bit, just you and I, is that it went up today, but who knows what will happen tomorrow, right? So we'll talk a little bit about how to manage that with your investing strategies as we go throughout the rest of this webinar.
Exactly. Yeah. And we will discuss it more. But if anyone looks at even what the market did over the last couple of months, we were sitting here in the July timeframe. The market had just hit an all-time high. People got worried about growth prospects, about the economy, about things, and all of a sudden the market fell off about 10% in a very short order, in a period of about 2 or so weeks. And it hit this low in August. And then all of a sudden it's rallied back, and which we're going to get more into this later on, so I don't want to steal the thunder for it, but it's really difficult to try to time the market. Markets can be volatile.
Right. I want to thank you for that news break. We're going to get back to our regularly scheduled programming and get back to school. So if we can pull back up the slides. I'm going to monitor questions in the chat. So if you have questions for Doug or for me, please put them in the Q&A chat and we will do our best to answer them in real time or after the fact. We also have customer service here. So if you have questions for them, they're also here. And we'll get to our programming. All right. So we're going to start with investment accounts. We're talking both about taxable and non-taxable accounts, giving everyone here a quick overview on what's possible for you. At Stash, we offer both personal portfolios, smart portfolios, or managed portfolio, plus retirement and kids accounts. Doug, I'm hoping that you can give us a quick recap of what these are, and then let's go into a little bit more details about the types of available investment accounts.
Absolutely. So to start off, everyone, if anyone wants to invest, you need to open some form of an account to invest in. You can't just go to let's say you bank at Wells Fargo or Capital One or Chase. You can't just go in and invest at the bank branch. You need an investment account, and there are various different.
Well, that's where Stash comes in, right?
That's where Stash comes in, and at Stash, and I'm going to get into more of this in detail. But at Stash, currently we have 4 different types of accounts. 2 of them are what we call taxable investment accounts, and I'll explain what that means. And those 2 are your Stash managed portfolio, which is our smart portfolios, which is a account where you put in money. Stash, we professionally manage it for you. We do a diversified investment portfolio. We monitor it. We make changes to it when necessary. And we have a Stash personal portfolio, which is a self-directed account where we give you some advice and guidance, but that's an account where you choose your investments. And both of those are what we call taxable brokerage accounts. And again, I'm going to get into a little bit more detail in that in a couple minutes. Additionally, we offer retirement accounts. We offer IRA accounts with the choice of doing either a traditional or a Roth IRA. Again, I'll spend some time doing that. And then we have what we call kids portfolios, which are really custodial accounts. You may know them as UTMAs or UGMAs, depending on which state you live in. And I'll discuss what those are.
All right, so we have another slide here where we compare some of them,
Okay.
specifically talking about tax advantaged retirement accounts.
Perfect. You know what I was going to say? I don't know if we have a slide on taxable accounts. So why don't we take a step back and talk about the tax
Sure.
treatment of a regular brokerage account. So when people think about regular, so this is not the retirement accounts we see here, but a regular taxable account, such as your personal portfolio or smart portfolio, or an account you may have at another brokerage account. Those are accounts where you have the choice as to what you invest in, and earnings are subject to taxation in the year under which you either make earnings, you sell something, and that. The benefits of it is that there's some flexibility. There's a large, usually depending on where you are, like at Stash, you could choose from thousands of stocks or ETFs, or if it's in a smart, it's where we do it for you. The benefit is there's no penalties for withdrawal. There are no contribution limits. You can invest as you please, when you please. They're ideal for investments that are not really for retirement or for something where you want to get a tax efficient strategy out of it. So that's just one to cover those before jumping into retirement accounts in general. So when you think about retirement accounts, I'm going to break it down. I know we have some types of accounts listed here, but I would really like to think about them as sort of employer-sponsored plans and non-employer-sponsored plans. So for all of you that work and you have a job, you may have a job that offers you a 401k, or you may work in an organization which has a pension plan, or maybe you're a teacher and you have a 403b plan. So these are all plans that are considered employer-sponsored plans. They all have different tax advantages and different limits as to how you can invest. But one of the things that we always love to say, and anyone will recommend, is be very cognizant of your plan, read the details, and understand if your employer does a match. So certain companies, for example, you might have a 401k, and they may match your first contribution, your first 3% or 4% or 5% or something of your contributions. To the extent you have an employer that is offering that and you can afford to do it, take advantage of those plans. Any money where someone is giving you money for free, that's the golden ticket in life. So if you can take advantage of it, please do, and please try to maximize those values. There's also some health savings accounts and some other types of accounts that your employer may offer. So if they do, reach out to your human resources office, understand the literature. Anytime that they talk about matching, take advantage. Any tax opportunities to avoid tax or defer tax or limit taxes, always great strategies to the extent you can. So now let's talk about the main ones that people talk about for when you're not an employer plan is something in IRA. We have those at Stash. IRAs are great in that you have tons of investment options, typically where you can choose what you want to invest in. They're yours, so if you switch jobs, it's not an administrative burden where you do that. There are some limitations, though, in terms of the amount you can contribute and some income limitations. The other thing I should point out with also for 401ks and IRAs are super important. This money is meant for retirement. That means that you are putting the money away and you are not taking that money out until you're 59 and a half. Now, there are some certain circumstances where you can take that money out earlier, but you should assume that you're putting the money away for a long period of time. So if you do take it out earlier, assume you're going to pay taxes, penalties on that. So invest in them. We are very big proponents of any of these types of accounts, but also remember that you're putting your money and you're sort of locking it away for your future self. Great thing to do, but that I'm going to get into in a little bit about how to think about retirement, how to plan and all that. Also, at the bottom of this page are a couple of other accounts just to think about because we have a lot of stashers. You may be one of them. That's a self-employed stasher. Maybe you either have a small business or you're working for yourself, you're a consultant. Some of those types of things you can look into. There are things like SEP or simple IRAs, which are self-employed retirement plans. Those I would recommend really reaching out to your tax advisor if you have one about setting up, because those could also be great ways to save for retirement.
Thank you for that summary, Doug. Super helpful. While you were talking about a couple questions, Mike was asking, as it relates to a personal portfolio, why doesn't Stash offer all stocks in the market? And I thought maybe you could speak a little bit to how we customize our offerings.
That is a great question, Sarah, and I'm glad. Mike, thank you for asking that question. So you are correct, Mike. We do not currently offer all stocks in the stock market. We have I should know this exact number, but it's between 3,000 and 4,000 stocks available for purchase, both U.S. and international stocks. So we are a registered investment advisor, not just a broker dealer. There is a distinction there. Broker dealer, there are many of them out there, Schwab, Fidelity, Robinhood, even, where you could go out and they may have everything. As a registered investment advisor, we do limit some of the exposure, and we don't put some stocks on the platform. In particular, we don't have some penny stocks, some microcap stocks. The reason is it's really a risk question. Some of these stocks trade very thinly, meaning they don't trade a lot, or they're trading at very low values. They're highly volatile. So what we like to do is we like to, not include those on the platform, really is a safety thing. But you are right, Mike, that we don't offer those. We don't offer everything under the sun, but we offer the thing. And that is actually an interesting aside. I was doing a little analysis earlier today and was looking at all the investments on the platform and who owns what and all that. And surprisingly, despite us offering thousands of stocks on a platform, and we have a lot of money in ETFs, but the money that is invested in stocks that are self-directed, the vast majority, well over 90% of all of the dollars invested are in fewer than 100 stocks.
Interesting. More to come on that. Let's talk more about that. All right. Lots of good questions coming in, but I want to move to our next section to be sure that we cover off on all of our curriculum points. And I'm going to weave some of your questions into this. So we're going to talk about investing techniques. Doug, maybe we can look at the next slide. We can move. So I'm asking you about dollar cost averaging and buy and hold strategies. Oh, we think we're going to cover children's accounts too. Can we talk about this quickly, because one person had a question?
Absolutely.
So actually the question was, I'm an uncle, and can I invest for my nephew or niece, which I think relates to this. So maybe we can talk about this quickly, Doug, because we're already slightly off of our schedule.
Sure. Sorry, we'll be very quick. Okay, so yes, you can invest on both at Stash or elsewhere for your nephew or niece. There are a bunch of different ways to invest. At Stash, we offer custodial accounts. Custodial is UTMA, UGMA, depending on which state you're in. They offer plenty of flexibility, your ability to pick and choose things. A couple of things to remember: that money becomes the child's money when they turn 18 or 21. And while these are great tools to give someone money and for them to grow and to learn about investing, one of the things is that they do count against the child for financial aid. There's another thing that you could look to invest in called a 529 plan. That is not, Stash does not offer a 529 plan, but every state does. So you could Google around if you live in whatever state you live in, Google, find your state-sponsored plan. What those are great for is that's for college savings. So if you want to help your niece or child pay for college down the road, if you invest now, it grows tax-free, and sometimes the contribution can go against your income as well, your income taxes in the current year.
All right. Now that we've covered that, investment techniques. So we're going to talk about next slide, dollar cost averaging and buy and hold strategy. And maybe you can weave in an answer to Cassidy, Doug, as you answer these questions. Cassidy wants to know, one of her CDs is maturing and it's a fair amount of money. And her question is, how should she think about investing that lump sum? So I know that's related to some of the points you were going to make here.
Yep. Okay. Hi, Cassidy, and thank you for the question. So dollar cost averaging, we talk at Stash a lot about regular investing, and there's a really major benefit to doing regular investing. One of them is that you can benefit from dollar cost averaging, and dollar cost averaging means that you're going to regularly invest a set amount regardless of market conditions. So you may say, hey, I'm going to put away out of my paycheck, which I get paid weekly, every week I'm going to put $50 away in the stock market. And I'm going to invest or into my smart portfolio or into an ETF. And every week, regardless of the value, I'm going to put $50 away. So sometimes you're going to be buying up, you're going to be buying down, you're going to be buying up, you're going to buy down. But over time, you're going to get a great average cost price, and you're not going to worry about it. The benefits are two major benefits of it. One is it reduces the impact of volatility, and it reduces the emotional decision making. I know a lot of people, investors are notoriously emotional. People are emotional. When the markets start going down, people start selling. When the markets are high, like today, all-time high, people start investing more. So you get emotional. So if you take the emotion out and you just say, hey, look, I get paid once a week. Every week, $50 goes into my account. I'm on auto stash. I'm set up. You benefit from that dollar cost averaging and that regular investing. Now, Cassie, going back to Cassie, right? Going back to your question, your CD is expiring. You're coming into a lot of money, and you're thinking about, well, how should I invest that? So at Stash, we like to say you should invest what you can afford to invest today into a diversified portfolio and continue to do regular investing thereafter. Now, I don't know, Cassie, unfortunately, I don't know all of your accounts. I don't know all of your things, but like if you have a large lump sum, here's a good example. Sometimes people say, hey, my great uncle that I didn't know that was really wealthy, passed away and left me $10,000. What should I do with it? And so we say, well, look, if you didn't have the money before, maybe you put in the majority of it into the market, you put a little bit in each going thing, and that's just allow it to grow over time, because the longer you're invested, the more money you will have, because over time the market goes up. The one caveat I would say, Cassidy, is that if let's say you have a CD and it's for X dollars, doesn't matter, but you have a big expenditure that you know is coming up in the next month or 2 or 3 or 6 months, I wouldn't think about necessarily investing that if you need that money for other purposes.
Thank you for answering that question, Doug. A couple points I wanted to make, which is just historically the stock market over time has gone up. Of course, we cannot promise that will be what will happen in the future.
Yeah.
And also, Stash makes it really easy to do what we're describing, which is through a tool called Auto Stash, which you can set it and forget it and invest whatever amount of money into whatever investment you're looking for over time on a regular basis. And that's what I was talking about before, which is on average, people save about $30 using Auto Stash, and over time that grows to about $1,000 in a year. Desiree, I hope Doug's answer answered your question. I have no idea on how to buy or sell or when to make it worth my investment, but hopefully he explained that there's never better time to invest than now. Doug, you have something else to add?
Yes, Desiree, if you don't know what to buy, that's a good question. Lots of people come to us. That is the power of our managed accounts, our smart portfolio. These are accounts where you don't need to know what to buy. You just need to realize that you're ready to get off the sidelines and to start investing. We take care of it for you. We put you into a diversified portfolio. I'm going to talk about diversification in a second here. but it's really a set it and forget it type of portfolio where we're managing it, we're rebalancing it regularly, we're making sure if the market moves that you're well invested, and it's geared towards your risk profiles. You answer a set of questions, we help you out, and we put you into one. So if you're having trouble, and we never want people to be overwhelmed by the decision of what to invest in or how to choose the right investment, if that seems challenging to you, that's why we have smart portfolios. And what we've realized is that close to 80% of new stashers, when they sign up, choose to invest in smart portfolios.
Right. Thanks, Doug. And you can auto stash into your smart
Yeah,
portfolio, your managed account, and make
exactly.
it all work seamlessly and allow us to do all the work for you. All right, let's move on to our next session on diversification. We did get one question. I'm sorry, I missed the name of the person who actually was wondering what is an ETF. So Investing 101, this is a perfect time to answer this question. Maybe you want to start because ETFs are so critical to diversification strategies. Doug, why don't you start there?
Okay, so an ETF is a fund that trades on the stock market like a stock, but it's very, very different than a stock. Think about an ETF as a basket that holds lots of different other investments. So, for example, I spoke earlier tonight about the market and S&P 500 being at an all-time high. There are ETFs where it's one investment. You invest in this ETF, such as what we call match the market, which is the iShares Core S&P 500 ETF, where you make one investment and it gives you exposure to all 500 stocks in the S&P 500. So you don't have to actually go out and buy each one individually. You buy one investment, and you get all of them in one. And there are ETFs that allow you to get exposure to bonds and to foreign stocks, or you could buy an ETF that's focused on a specific industry. For example, if you want to invest in the healthcare industry or the tech sector, there are ETFs that will give you a basket of all those types of stocks. Now, what to know about diversification, because I think this is an important part, and this is a cornerstone of the Stash way. It is, most people here might remember from your childhood hearing a little statement that says, don't put all of your eggs in one basket. And the reason you don't want to put all of your eggs in one basket is because if the basket falls, right, the egg breaks, that's it. You never want to invest all of your money exposed to one thing. An ETF might be different because it's giving you exposure to lots of things in one investment, but you don't want to take all of your money and put it into, for example, Apple, and it's my iPhone, or put it all into Tesla or anything like that. You want to have a diversified portfolio. So diversification is investing in two or more securities, whether those be stocks, bonds, ETFs, that don't move the same way. So maybe when one goes up, the other one goes down, or when one goes down, the other one goes sideways. And when you put these all together, they actually reduce your risk dramatically. I'm not going to get into funky detailed math here, other than to say that when you build a portfolio, the way to do it is to get lots of different things that have a different exposure to different things. So we have at Stash our diversification analysis, which will look at your portfolio for you and will give you a breakdown of how much of it is invested in US stocks, or foreign stocks of developed markets, or in bonds, or in emerging market stocks. And through that, we could give you a rating of how well diversified your portfolio is, and make a recommendation of an ETF or two or three or four, depending on your portfolio, that would help you round out your portfolio so you're a little bit more balanced.
That's a great answer, but I do want to say there's a lot of questions here about what are the fees for our smart or managed account. Excuse me, Patrick and Shepard, is there a charge for that? And the answer to all of that is no, right?
No. So at Stash, we are pretty transparent that we do have a subscription fee. So to invest in Stash, you have a subscription fee. That being said, there are no incremental fees for managing your money within Smart Portfolio, all the rebalancing, all the target allocations, all of that is included. If you have auto stash turned on, there's no extra fees for that. It is all in there. I should probably point out that every ETF has a de minimis fee embedded in it. So, but that's not a fee that's going to come out of your pocket. That's in the fund itself. And for the most part, I think the overall smart portfolios were less than 10 basis points. So that means if you're investing $100, it's less than 10 cents of fees that per year that are going to the fund management companies, but you wouldn't see that that's actually in the ETFs themselves.
Thank you for that PSA in particular. All right, let's move to retirement planning. There are a handful of questions on retirement planning as well, so I'm going to go back and find them. If we can go to our next slide here. So many people ask us, is it too late to start? And also, how much should I set aside for retirement planning? And I do know that we got a question about how to think about planning for retirement and putting money into a retirement account versus putting something into a managed account or personal portfolio. So can you address all of those points, which are really how should people think about starting their retirement planning work?
So the first thing you asked, I think, was, is it too late? And I hear it all the time. I have lots of friends. I know a lot of people. They say, hey, is it too late to really be doing this? Well, it's never too late. But the best time to start is always today or yesterday, or, so the earlier you begin, the better it is. And I know we have a lot of, I don't know the ages of everyone on this call clearly, but we have a lot of stashers that are younger in their careers, maybe coming out of college. I remember last call we had a someone that she was just about to graduate college, and she was asking questions about that, which was great. And so if you could start out of, early on, out of every paycheck, doing auto stash or doing regular investments into your 401k or into your pension plan or 403b, that's a fantastic way to start building for retirement. But regardless of when you start, doing it is better, because you will start growing your money over time. The second part of the question, Sarah, was?
Second part of the question was how to think about how much money to set aside and what to invest in, and also how to think about putting money away into something like a smart or a personal portfolio versus investing in your retirement planning. And also, by the way, you talked about a very young attendee from our last webinar. We do know that we have many people who often come to our webinars who are much closer to retirement. So people who use Stash and Stash services, so many different types of ages and generations. And our offers and our advice in particular, of course, Doug's advice is applicable no matter what stage you're in.
No, I think that's right. So I'm going to give a rule of thumb, but I don't want anyone to get scared by this rule of thumb. There is something called the 4% rule, and the inverse of the 4% rule is what we call the 25 times rule. And the easiest way to think about this is if you could think about how much you need in retirement, or how much your income is prior to retirement. If you multiply that amount by 25, that's a good proxy for the amount that you should have saved up by retirement. If you have 25 times your annual income or your annual expenditures saved up by retirement, that will should enable you to be able to spend about 4% of that per year for at least 30 years, if not longer. And so that's a good rule of thumb. Now, that is not, while rule of thumbs are great because it gives you averages and things, for some people, you may want to try to retire earlier or have an extravagant lifestyle in retirement, under which case it might need to be 30 or 35 times. And others are saying, hey, I want to work, until I'm well into my 70s or 80s, or always want to be active. I have a much more modest lifestyle. I don't need to spend a lot. And those people might be better off with 20 to 15 times their income. So I think that's a great starting point to think about. In terms of a smart portfolio versus a retirement account, the benefits to retirement accounts are that you get some tax efficiencies. And so depending on the type of account, if it's a traditional account or a Roth account, a traditional account allows you to take a tax deduction now, then it grows tax-free. But then in retirement, you take it out and you have to pay the taxes on it. Versus a Roth retirement account, you pay all those taxes now, you put it in, and then it grows tax-free forever. And when you take it out, you don't pay taxes. So there are benefits, there are tax efficiency benefits to utilizing some of those accounts. A account like a smart account is also a phenomenal way to save for retirement. The difference is that you're not getting the tax benefits from it. But it's a great, and regardless, what's great about Smart is that it's managed for you, it's diversified. But however you choose to do this, whether or not you do it in a smart portfolio, which currently we only offer in a taxable thing, where you invest in a retirement account, make sure that you're investing appropriately in your retirement account.
All right. I'm going to start to take other questions.
Okay.
Some of these are going to be related to retirement, but others will not. So maybe we can take down the slides just for a minute before we pull them up again. So Gail wanted to know, is there a minimum number of investments that you should have?
Gail, that is a fantastic question. And I love this question. The short answer is it depends, which Sarah is always going to hate me for saying depends and not answering. But if your one investment was your smart portfolio, you could have one investment because the underlying holdings, it is giving you exposure to thousands of stocks and thousands of bonds. So that is a very well diversified portfolio. You can make one investment. There are also some ETFs that provide tremendous diversification, whether they're full portfolio diversified ETFs or whether they're even an S&P 500 ETF. Now, I'm not necessarily sure I'm recommending to anyone that you should have 100% of their money just in US equities. But if someone was to make an investment in a broad-based US equity ETF like the S&P 500 one or even a broader market one, and maybe a bond ETF, that would be two investments, and that would give you diversification. What we don't love to see is that someone comes in, and I sort of mentioned this again, is that they take all of their money and they put it into one individual stock, because that's where all the risk lies. And if you are going to invest in individual stocks, we applaud you. It's a lot of work. I think we did this in one of our last portfolios, one of our last webinars, but we'll probably touch on this a little bit on Tuesday as well. Make sure you do a lot of work and a lot of homework on that. And we always recommend trying to keep it to no more than 2% of your overall portfolio, just so you're not so concentrated in the name.
Thank you for that. And we haven't actually mentioned this, but our managed account is also, we assign a risk level, or you assign the risk level to yourself. And so the portfolio construction is rooted in your appetite for risk. And so they can be different depending on who you are and what you're looking to achieve.
Exactly.
All right. A couple more questions before our time is up. JLT, when is the right time to sell your stock?
JLT, that's another great question that we get a lot. So choosing when to sell a stock, I would say it really boils down to why you bought the stock in the first place. So when you buy a stock that you're buying a price, you should have a target, you should have an investment thesis for what you think, why you're investing in the stock, and you should have a target price for that stock. So times when you should evaluate selling it are, number one, maybe the stock has reached your target price. Number two, maybe it's become too big in your portfolio. Remember, we said we like to keep things under 2% of your portfolio. Well, let's say you have something and it's a real winner. Now, all of a sudden, it's become so large relative to your rest of your portfolio, maybe you want to choose to trim it down. So those are really good times to think about selling, or potentially you need to raise money for something. So maybe you want to, sell your overall portfolio. The bad time to sell is based on just a market move that is not necessarily specific to the stock. So if something happens in the market and you're worried about it, that shouldn't be the reason to necessarily sell. if your long-term thesis is there, but maybe something's changed with the company, so your thesis has changed, those types of things may trigger a sale.
Thank you, Doug. And one other note that I wanted to make is that on Stash, we've renamed a lot of our ETFs so that it's very clear what you're investing in, whereas in other platforms, it might not be so obvious what the fund is all about. That's a benefit of Stash as well. All right, last question, unfortunately, that we have time for. And this is related to the first point about interest rates. And I think you'll see the tie, Doug. So Marcus is asking, what about those of us who are investing for the short term, such as for a car or another large purchase? What do you recommend for us?
Great, thank you. And that was Marcus?
Yes.
Hi, Marcus. So also another wonderful question. So, and I love that you pose this, investing for the short term. So it really depends on how short you're looking here. Anything under a year, you shouldn't be investing in something risky or riskier, right? Like, so anything that could go down. If you need, let's say you're trying to save up and you need to have $10,000 for a down payment on your car, and you have all that already saved, but you're not going to buy it yet for another several months. You don't want to risk losing that money. So a good way to do that is something we have some very short-term bond ETFs on our platform, such as I'll give you some tickers like TFLO or JPST, which are BIL, they invest in very short-term bond funds. Now, these things have a lower, I can never say zero risk, so a lower chance of risk. At the same time, you're not going to get, tremendous returns. A few weeks ago, before the Fed cut interest rates, these were yielding about, I think like 5.3, 5.4% per year. The Fed just cut rates. I wouldn't be surprised if in the next few days, these go down to under 5% to closer to 4.8 or 4.9, because they will match what the Fed's rates are.
But still much better than cash as a way to grow your.
Still much better than cash. But again, if if you have several months, maybe a great thing to do. If you're trying to buy, if you're looking for next week, you need to spend the money, I would say, hey, maybe you should move it over to cash and just be ready to make the purchase.
All right, thank you, Doug. If we can pull back up our slides, just a couple public service announcements, and also just a reminder too, which is that first of all, if you want to make sure that your friends get access to webinars like these, you can scan this QR code, and when your friends sign up for Stash, you'll both get $20 up to $1,000. So everybody gets rewarded and gets on their way to investing success. And then next slide, please. This is the first of 2 webinars. So if you scan this QR code, you'll be taken to a landing page with information on our next webinar. We'll also be sure to email you. That's next Tuesday, where we're going to be doing Investing 201, a little bit more advanced topics, but equally as broad ranging, and we'll be sure to answer all the questions, as many as we can, that come in. I want to thank you all. The information we shared today is purely educational. We're not providing any financial, legal, tax, or investment advice. Again, our next webinar is Tuesday, September 24th for Investing 201. That's my cue, the lights turned off. Anyway, thank you to everyone for coming, and I hope to see you again next week. Thank you so much.
Thank you, everyone. Thanks, Sarah. Always a pleasure.
Thanks, Doug. Bye.